Hey guys, Muka here from StockAviator.com, and today we're going to go over a few gap plays. So these gap plays are pretty simple. The way they work is basically you're trapping people either in a stock or you're looking for people who are panicking and selling out of their positions or people who are taking profits. So basically all you need to do is think of what is happening and what would you do if you were the person who took this trade yesterday. So as we know, trading is emotional and dealing with those emotions. So what you need to do is just think of what these people are thinking and how they're feeling and what their reactions could be or might be, and let the chart really decide what is going to happen from there. So anybody who's done a gap video or been to a webinar about gaps probably have seen these before. The people running those webinars or teaching these might call them something different. There's 100 different names for them. It doesn't really matter what you call them. All you need to know is what is happening and why they work. So if the previous candle day was green and then the stock gaps up, what we're going to look for is a pullback and a retest of support, and then you're going to enter for a continuation of the run. And then if the previous day was red and gaps down, it's the same thing, just in the opposite direction. You're going to be more bearish and you're going to look for a retest of the resistance and then a continuation to the short side. The second gap play is a play that traps people into their trades. This is a play that the previous day was green, so it was a positive bull day, and then all of a sudden the stock gaps down, or the reverse, the candle was a red day and the stock gaps up. So now traders who bought the day before on that green day, they're in the profit, and now it gaps down and all of a sudden their account's in the red. So they're either going to be forced to sell by their broker who are hitting the technical stops, they're going to be forced to sell by hitting their own stops, or they're just going to be emotionally distraught and sell anyways because they've taken too big of a loss. The only other reaction there would be is, oh well, the stock's already down 20%, I'm going to continue to hold. So keep those in mind while you're trading these gap plays. At the end of the video, I'll show you guys how to scan or find for these gaps and what to look for in the gap and what makes it a good gap play. Alright guys, so here's SPY. The first thing I'm looking for is a gap that gaps at least 4%, and maybe less than 30%. It doesn't always have to be less than 30%, but a larger gap tends to have either rejections or bounces in between. So let's just run 4 to 30%, 35% just to be safe. The first thing you're looking for is, of course, the previous day. So on this example, it was a green day. And then the next thing you're looking for is whether it's a gap up or a gap down. That's really it. So as we said in the beginning of the video, you got a previous green day, a gap up, so we're going to look for some sort of pullback or retest of support, and then we're going to get in. So we need to switch over to the 1 minute chart. You have your gap up, you have a pullback, and then you have a ramp. So you could say this is a retest, this is a pullback, if you're quick enough to catch this. If not, that's fine, because this is also a pullback. So you could also buy here. Some traders like to do this a little differently than I do. I would have liked to buy it at the lower portion of these pullbacks, because then you're just risking the lower candles wicks as your stop out point, because obviously if it goes any lower you're creating new lows and that could be an indication of a rollover, and so you'd set your stop right below those points. So I'm going to scale this chart so you can see better. Alright, so you would see this pullback, you'd see this candle, and as you can see it kind of jogged up and down a little bit, and you could enter anywhere in this candle range, and you would want to stop out, of course with some leeway, below 207.22, and even if you use this one at 207.24, Usually we give ourselves some buffer room on our stop, so you'd probably run like a 207.20 stop, and you would have been fine. You wouldn't have got stopped out there, and it would have ramped up to 208. The other way to take this trade is to wait for the confirmation. So you get this run up, and then you get the pullback, and the confirmation point would be above that candle. So as soon as this breaks out, you would go long here at this level, 207.38, with a stop at 207.22. This is waiting for the confirmation breakout, and this is waiting for that ramp. So the only way you'd ever stop out is if this completely fails, rejects, bounces, and come back down. On the other hand, if you do it this way and you buy down here, you've mitigated your risk. However, there's no guarantee that it won't reject off of this candle again. So, it just depends on the style of trading you want to do, but that's two different entry methods you could take. But let's say we missed that entry, so we're waiting for a pullback from here, and it pulls back down to here. So we see this big pullback, it rejects the bottom, it begins to form a base. We'd want to get long in this base. So at that point, what we'd look for is an entry like this, with a stop out at the lower level and an entry at the upper level. So a 207.60 stop and a 207.70 entry. And then you could see this jogged around a little bit before it actually started grinding up higher. Either way, it works. And this is similar to the ABC trade pattern. However, we're obviously playing gaps. Next example, GENE. What we're looking for is the previous day. We see that it was green, and then we see the gap up, which also happens to be above any prior resistance levels. So now we have a very bullish stock. Switch over to the 1 minute chart. Let's remove the indicators. You can see we've got a really good gap. You got the run up, a retest if you wanted to use that as your first retest, but no big deal if you missed it. There was another one right there. So you got the run up, the retest, and then the breakout and grind higher all day. This was a perfect example. You would have got in anywhere between 415 and 425, and this ran all the way to $5 at the end of the day. So once again, you'd want to stop below your lows and enter anywhere in between. And then you can calculate your risk, of course, which we'll go over in a later video. And you can determine, your share size or position size based on your risk allowance. Alright, last example of this one. Green candle, previous day, into a gap up above the most recent resistance levels. And you can see a huge run afterwards. So we need to switch over to the 1 minute chart. This one was a bit of a choppy, grindy chart, but it still worked. You can see the gap up, the pullback, and then the continuation. And it never came back below our stop. You could have bought and sold, or you could buy and hold. So these work in multiple different scenarios. And these ones that gap up above resistance levels tend to run a little bit longer than the ones that get stuck on resistance or stopped by the resistance levels. So the other pullback play here would have been from here to here, back down. You got the higher low support. On this one, you would buy on the breakout over here and stop out under these. So 580 stop and a 585 trigger. Or you could buy on the confirmation of the higher low, which would have been around 595, and stop below this at around 580, 582, anywhere in that area, and continue to ride the trend. So this one's a green day prior, gap down. One exception to the rule, this is quite a bit more than 35%, more than likely. I haven't done the math. but it's probably pretty close. But as we've said, when it gaps down, it passed prior supports. So we're going to look for continuation anyways. The thing unique about going green to red is now you have all these people who bought here, 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 down here, thinking the stock was going to go higher, are now trapped down here. So, like I said, you have to think, what's their reaction? What are their emotions right now? What would you do in their position? Alright, so we got the gap down from way up there down to here. The retest. And then the all-day fade. The other pullback you could have tested is from here down to this run, down to this retest, and then of course the all-day fade. So in this case, you'd want to confirm the breakout below here and stop, of course, above here, that range in there. Or you would use this level. Something like that. Pretty simple. So this one, huge green candle and a gap down. Why wouldn't I play this one? Two reasons. There's a huge catalyst about a possible buyout. That's why this huge candle is green. So when you see big, huge, one-day overextended candles, look for news before you play the gap. 2. This isn't 4%. The gap was kind of weak. Could you have made money on this if you played it? Yeah, you probably could have. But there's better plays out there to play. So you have this tiny gap down right here. The initial move, a retest, a pretty solid top that you could use, and then of course once it broke down lower, your trigger. Now as you can see, it bounced right back. However, it never executed your stop until here. You likely probably would have took profits when it bounced back over this level here anyways. So yes, you could have made money, you could have played this. You could have even played this retest and went short again for a small gain, but by the time you realized that this was reversing, you got stopped out up here. Probably not a huge profit. So like I said, there's better gap plays to play than this one. This is why I run that 4% rule. So here is how you can find gaps after hours. Now granted, things can change pre-market, so watch the pre-market before you jump into the gap play right away. But the stockmarket watch.com/markets/after-hours/trading.aspx, and the tab over there is of course for pre-market, so you can see the pre-market ones as well. This one will simply tell you the percentage of change of stocks up or down, which ones are moving after hours. This website I would consider a little better than the other ones. However, the downfall is it doesn't update until 30 minutes after market open, so you won't be able to do your pre-market scans with this one. This one is www.barchart.com/stocks/gapup.php, and of course there's also the gapdown.php, and you could just click on the hyperlink over here on the left to do the gap down stocks. You can sort these by their columns. The great thing about this is you can see how much they're gapping, so you make sure they fit the criteria. You see the price of the stock, make sure you can afford to buy it, and then you can of course just input the stock into your chart and go look at it.